Here is a question worth sitting with on this 4th of July weekend. If you could own a single company that controls roughly a third of the entire global cloud computing market, is building its own artificial intelligence chips, and is actively backed by some of the world's most sophisticated hedge funds, would you? Because that company exists, it trades on the Nasdaq under the ticker Amzn, and as of today, the 4th of July, 2026, serious investors from Wall Street to the City of London are asking one very pointed question. Is Amzn one of the best AI and technology stocks you can buy right now? Today we are going to answer that thoroughly, with facts, figures, and analyst insight, no fluff, no noise. Let us start with exactly where Amzn sits as a business in July 2026. Amazon Web Services, or AWS, remains the single largest cloud platform on the planet, holding approximately 31% of the global cloud infrastructure market, ahead of Microsoft Azure and Google Cloud. But AWS is no longer just storage and compute. It is now Amazon's primary vehicle for artificial intelligence deployment. Through its Bedrock platform, AWS gives enterprise clients access to foundation models from Anthropic, Meta, and others, alongside Amazon's own Nova model family. This is a meaningful shift. Amazon is not merely a cloud landlord anymore, it is an active participant in the AI stack. Meanwhile, the core retail and advertising businesses continue to generate the cash flow that funds all of this ambition. Amazon's advertising segment alone has grown into a multi-billion-dollar annual revenue engine, rivaling established players like Meta in digital ad spend. The pace of change at Amazon over the past several months has been remarkable. First, Amazon has doubled down on its custom silicon strategy. Its Trainium 2 chips, designed specifically for training large language models, and Inferentia chips for running AI inference at scale, give AWS clients a cost-effective alternative to NVIDIA's GPUs. This is significant because GPU supply has been constrained and expensive. Amazon's in-house silicon allows it to offer competitive pricing that keeps enterprise clients on AWS rather than drifting to rivals. Second, investor confidence from institutional players has been notably strong. According to data cited this week, investor Richard Chilton's fund counts Amazon as a top AI holding, and multiple hedge fund analyses published in late June 2026 list Amazon among the best cloud computing stocks favored by institutional money. Third, UBS issued a bullish recommendation on Amazon in mid-June 2026, pointing specifically to AWS growth acceleration and the monetization of Amazon's AI infrastructure as the primary catalysts for the recommendation. One angle that deserves its own section is Amazon's positioning in the AI chip space, because it is frequently underappreciated by retail investors. When people think of AI chips, NVIDIA comes to mind immediately. But Amazon has been quietly building a vertically integrated silicon stack for years. Trainium 2, manufactured on TSMC's advanced process node, delivers competitive performance for model training workloads. Inferentia 3 handles the deployment side. By owning this stack, Amazon reduces its dependence on third-party chip suppliers, lowers its own cost of goods, and critically, passes savings on to AWS customers. A recent Yahoo Finance analysis published in late June 2026 examined whether Amazon could be considered a best-in-class AI chip stock for long-term investors, and the conclusion was broadly positive, precisely because of this infrastructure ownership model. It is a different thesis to buying NVIDIA, but it is a compelling one for investors who want AI exposure with a diversified revenue base beneath it. Amazon is a constituent of the S&P 500 and the Nasdaq 100, which means its performance has an outsized effect on index funds and ETFs held by millions of ordinary investors. When Amazon performs well, a significant portion of passive investment portfolios benefits automatically. But beyond passive exposure, the active interest in Amazon is also influencing the data center and REIT sector. Amazon's capital expenditure on physical infrastructure, new data centers, fiber networks, and power capacity is a direct driver of demand for data center real estate investment trusts and energy providers. U.S. News flagged this dynamic in its analysis of the best data center stocks and REITs published at the end of June 2026, highlighting that hyperscaler spending from companies like Amazon is the primary demand engine for the sector. So owning Amazon is, in a sense, owning a piece of the infrastructure build-out that the entire AI industry depends upon. No credible investment analysis is complete without an honest accounting of risk, so let us address it directly. The most significant near-term risk for Amazon is regulatory pressure. Antitrust scrutiny of big technology companies has intensified in both the United States and the European Union, and Amazon's dominance in e-commerce, cloud, and increasingly in AI services makes it a visible target. A forced structural change to AWS or the retail marketplace would materially alter the investment thesis. The second risk is capital allocation. Amazon is spending at an extraordinary rate on AI infrastructure, and if the return on that investment is slower to materialize than the market currently expects, earnings multiples could compress. Finally, competition from Microsoft Azure, which has a deeply integrated relationship with OpenAI, and from Google Cloud, which is deploying Gemini models aggressively, means that AWS market share lead is being contested more fiercely than at any point in the past decade. These are real risks, not theoretical ones. Looking at the near-term outlook grounded in current evidence, the consensus among analysts who have published views in June and July 2026 is constructive. AWS revenue growth is expected to re-accelerate as the AI workload cycle matures and enterprise clients move from experimentation to production deployment. Amazon's advertising business provides a high-margin floor beneath the overall company earnings. And the company's logistics and fulfillment network, while capital-intensive, creates a moat that is genuinely difficult for competitors to replicate at scale. For Amazon specifically as a stock, it continues to appear on multiple institutional screens for best Nasdaq holdings over a 3-year horizon, as noted in a mid-2026 analysis. The near-term catalyst to watch is Amazon's next earnings release, where investors will scrutinize AWS margin expansion and any guidance around Bedrock and AI monetization. A strong set of numbers that could serve as the next meaningful re-rating event for the stock. For viewers considering whether to add Amazon to their portfolio, the relevant frame is this: Amazon is not a pure-play AI bet in the way that a smaller AI software company might be. It is a diversified technology conglomerate with AI as its primary growth vector. That means lower upside volatility than a pure-play name, but also substantially lower downside risk, because the cash flows from retail, advertising, and established cloud services provide a substantial earnings cushion. Investors who want broad AI and cloud exposure without concentrating risk in a single technology layer, chips, software, or applications, often find that Amazon offers the most balanced expression of the theme. The hedge fund community appears to share this view. Multiple funds have maintained or increased their Amazon positions through the first half of 2026, as reflected in the institutional filings reviewed this week. So, is Amazon one of the best AI and technology stocks to buy right now? Based on the evidence available today, the 4th of July, 2026, the answer for most long-term investors is a well-supported yes, with eyes open to the risks. Amazon controls the largest piece of the cloud market, is building the infrastructure that the AI industry runs on, is developing its own silicon to reduce cost and dependency, and is generating the cash flow to sustain all of it. Institutional backing is strong, analyst sentiment is broadly positive, and the long-term tailwinds from enterprise AI adoption are firmly in place. That does not mean Amazon is without risk, and it does not mean it is suitable for every investor's risk profile or time horizon. But as a core technology holding for a patient investor with a multi-year view, Amazon remains one of the most credible answers to the question of where AI infrastructure investment is going to compound. Do your own due diligence, consult a qualified financial advisor, and make the decision that is right for your individual circumstances. Thank you for watching.